Good morning, everybody. Welcome back to another fun episode of the Tim and Tim Show with Making Moves in Multifamily Live. Tim Best, how you doing today, man?
Not too bad. Not too bad.
Trying to bring in a little extra energy to the show today because we're talking about something that I absolutely love talking about.
Got my coffee. I have my coffee.
I'm still working on mine too. I'm still working on it. But for some people, talking about this kind of stuff can be a huge drag, but other people, it lights them up. I'm the latter of the two. But I think that most people should have a better understanding of these investor metrics and how to apply them and why they're important to know how they're calculated in order to make the right investment decision for you. So Tim, what are some of the things that you look for, like as an investor, not as an operator, as an investor, what are some things that you look for in a good investment opportunity in terms of return metrics?
Yeah, for me, it's timeline. Not from an IRR perspective, but I am looking for timeline, equity multiple. And then after that, I'll start to look at like the average annual return. Um, I don't. I'm not at a position where I'm paying a lot of attention to IRR. And then quite frankly, right now I'm not paying a lot of attention to the cash on cash return. I'm a little bit more focused on building equity and increasing net worth as fast as possible. So
Yeah, equity multiple definitely is all about balance sheet growth.
yeah,
But I could make the argument here, and we will for argument's sake. I'm surprised that you don't pay attention to the AAR or average annual return because essentially that's the same thing as the equity multiple, right? Or it's the equity multiple is your total return, right? So if you
well, I
have
do.
a
I
50%
do.
return in 2 years, that's a 25% average annual return per year, right?
Yeah, and I do. I pay, like I said, I pay attention to equity multiple, and then the second thing I'm paying attention to is that average return.
Oh, so the first thing that you're paying attention to, the first thing that you're honing into is what is my overall return?
Yeah.
Hey, good morning, Dennis. Good to see you, buddy. Um,
Yep.
so the first thing that you're looking for, how much total money am I going to make, irregardless
Right.
of when, right? How much money am I going to make, and how
Right.
long is it going to take me to make that money?
Right. Yeah.
Um,
Absolutely.
those
Because
two things will derive your average annual return or AAR, which I mean, it's an interesting way to look at it. And it's always I like having this conversation with different people, myself included, because everyone's interested in something a little bit different. And
yeah.
part of our coaching program, we talk to the people that are learning from us, and they want to know what is the correct level of return. Is that a good way to say that? Yeah. What's the
Yeah.
correct level of return to offer your investors? And my response always is, I have no idea. And they're like,
Right.
Tim, we paid you to be our coach. Why don't you know what you're talking about? It's like, I do know what I'm talking about. What I can't answer is what somebody else's preferences are.
Right. Right.
And that's why it's so whenever you're having a conversation with an investor, the thing you have to do is ask them questions about what interests them, what kind of deals do they like, what kind of returns are they interested in. If I were to put something in front of I'm trying to think of a good example. If I were going to put something in front of you, oh, here's a good one. If I was going to put something in front of you, Tim, that was a 2x equity multiple, but it took you 10 years, I probably can guarantee you're not doing that deal.
No, not at
Right.
all. Not at least not at this stage of my life. I don't know what stage of my life I would do that deal, but definitely not now. Um,
Okay. Well, we can make an argument here of, well, it depends on the risk, right? If it's a
right.
risk adjusted return, does that make sense? And maybe not, right? But if
Right.
you're investing into a class A brand new triple net development, where the returns are typically low, say it's a Starbucks, for example, that actually might be a good return. I have full disclosure, I have no idea because I don't invest in Starbuckses and those kind of assets, but there are people out there for wealth preservation that a 2x equity multiple in 10 years with very low risk and very, very, very low effort, that could be attractive.
Yeah. Yeah. I'd want to see what the annual return, like the cash on cash is there.
Right.
If
I mean,
I'm
I
if
bet
I'm park
most.
if I'm parking that for a 2x in 10 years, there better be some pretty strong cash flow off that thing.
And that's fair for you, but it might not be
Yeah.
for somebody else, right? And
Yeah.
that's why I love this conversation, and I love having these chats with investors directly because I don't know what somebody else wants. I'm not trying to solve that problem. All I'm trying to do is learn and understand what that person is interested in so I know what kind of deals to put in front of them. Like, Tim and I, we work with a family office, and one of their metrics is they want a preferred return on their money, but they don't want to get paid the money because they don't need the cash flow. So they say, okay, well, I want my preferred return because that guarantees my, 7% or 8% pref or whatever it is. But they're more interested in what's the equity multiple and how fast are we going to move the money, right? It kind of is very, very similar to Tim Vest's point.
Right.
And I know that if I put a deal in front of them that is a 2 or 3x equity multiple in 18 months, but pays zero cash flow, they're probably in. But if
Yeah.
I show them the Starbucks deal that cash flows 4% per year, they don't have to do much, and it's going to be a 10 or 20-year hold, they're not interested in that.
Yeah, yeah. You and people, you'll see that people go through like progressions, right? You'll
Oh
see
yeah.
folks that, like even Tim and I are starting to progress, right? Where like we've gone through like 3 years of like heavy, what's the equity multiple? What's the equity multiple? What's the equity multiple? And that has been the focus, right? Like in
Mhm.
some places, even just sacrificing all cash flow for
Yep.
equity, right?
Yep.
And now we're starting to disposition, we're starting to turn some capital, things like that, and it's like, maybe now I want to shift some of that capital into a cash flow position that still earns, right? Still, but that equity multiple may be a 5 year instead of a 2 year, but at the same time, it's producing more steady cash flow.
Yeah.
So
Yeah. I
yeah,
mean,
we're starting to look at those kind of things now.
you had said something that kind of sparked my interest. I mean, that's why we're talking about this, is because we kind of talked about a conversation about investing money about a week ago now. And you had said something to me. You're like, yeah, I'm interested in the Class A shares of that deal that is a 12% preferred return, 1% paid monthly, not only because of the cash flow, but it was because I'm in the most secure position behind the bank. It
Right.
means I get my money back 100% first and my pref back first before anybody else. And that's the trade-off of, well, are you along for the ride with the equity and the depreciation, right? To go after and chase that equity multiple, or are you in it for the cash flow and not touching your principal balance? But when a refinance event comes up or a sale event comes up, I want to be guaranteed to get my money back first, before anybody. Now, I
Right.
use the word guaranteed. There's nothing guaranteed, but it's kind of for lack of better words. I get my money back first before anybody else. That sense of security, I was thinking about it. I was like, that does sound pretty nice. Hmm.
Yeah.
Yeah. But if you asked me that question 3 to 5 years ago, I'd be like, oh, no way. I'm all about the equity. I want the growth. I want to be along for the ride. I want to risk it for the biscuit. But and then you start having some cash and you're like, man, I've been risking it for the biscuit on every single deal, and it's stressful. I mean, these sandbars, tide's going out, and the sandbars are starting to show, baby, from the stress, and it's like, okay, well, how do we mitigate some of that stress and put it somewhere else?
Right. I mean, but think about where you are in your life too, folks. Like I talk some of our coaching students I talk to about this as well, which is like, hey, when you're sitting there with, let's say you're in a W-2 and you're investing, you're doing some of these deals and stuff like that. So you got some nice cash flow from your job, and you're like, I want to I want to go create equity as quickly as possible, right? But then say 3, 4, 5 years down the road, you got a couple million, and you're like, I could probably leave my job and put this couple million in a place earning 8% with an equity multiple that takes 5, 6 years instead of 2 years, 3 years. That may be very attractive to you because you're like, I can put the 2 million in, make 160 grand a year in cash flow, never touch the equity, and then the equity's still growing over time. That's not a bad spot to be either, right?
Mm-mm.
And you start to do that a couple of times, the next thing you know, you got a nice $300,000 a year tax-free salary, and you're never touching the bank. I guess the wad in the bank, right? So
But and that's a great point. But in order to get there, you got to focus on the equity multiple, right? You
right,
got you got to
yep,
focus on the overall return and the speed of the return. Um, and what they say is like going from zero to $100,000 is infinitely difficult. Going from $100,000 to $1 million in the bank is 10x, right? Requires a ton of effort and a ton of work. But to go from 2 million to 4 million, right? Or 1 million to 2 million, sorry, that's only a 2x return. So it's like, people always say when you get to, if you have a life goal of getting to $100 million net worth, you will get to 100 million, but then you will also get to 200 million because it's inevitable. Like as investing the money, like it's just going to continue to grow and it's going to
Yeah.
continue to go up. And that's why it's important to make sure you're focusing on your equity multiple. But there's other conversations around people that are focused on cash flow, which we kind of touched on why you might be interested in a little bit more cash flow rather than an equity multiple. But also the other metric that a lot of investors use as their general rule of thumb is the IRR, or internal rate of return. And essentially the IRR is a combination of your equity multiple, your average annual return, and your cash flow all in one metric. And it takes that total return and it applies the time value of money to it. So that time value of money says a bird in the hand is worth more than a bird in the bush, right? So the IRR will continue to go up if you receive more money starting faster, right? If you shift the time frame of when you're going to receive most of your money or some of your money, the IRR is going to go up. So for example, if you have a deal that you hold for 5 years and there's no refinance event, right? So your money's invested for the 5 years and you have a 2x equity multiple, that's a 20% per year average annual return. But your IRR is going to be much less than that. I don't know what the math would be. It could be 15 or 16% IRR. And you're like, well, wait a second. Why is the IRR lower than the average annual return? It's because potentially this deal that you've invested to for 5 years, the first 2 years you receive $0.
Right.
But then in years 3, 4, and 5, in year 5, you get your windfall from the equity, right? From the sale with the equity. But then you also start to make up some of the cash flow later in the life cycle of the deal. Therefore, your IRR is going to be lower. So some people will focus on IRR above all else because that's what they're important. That's what they think is important. And there's no right or wrong answer here. But it is not something that I truly pay attention to because I'm not really in the position to do it right now.
No.
I do focus on equity multiple. I have started transitioning to a little bit more focus on cash flow, like what's the cash on cash return, and it's much less of a percentage for me, and it's much more of a dollar amount, like an absolute dollar amount. Like what is the actual dollar amount that's going to hit my account every quarter? Because that means more to me than what the percentage is going to be.
Right. Yeah. And you get in all of these, you got to kind of be a little careful with. One of the reasons I like about AR and equity multiples, it's a little more geared to like what Vitali's talking about there. It's more of a measure of pure cash, right? And but one of the things I dislike about IRR, at least where I am right now, is it can kind of be manipulated. Like what Vitali's talking about here is like, hey, I created a capital event in the first 6 months where I gave you a lot of money back real fast. But then I didn't do much after that, right? And it took a little while. So because you created that capital event, you exploded the IRR, but then the return on the backside was, not as attractive as something else might have been. Now at the end of the day, the IRR still looks really good. So that's one of the reasons why, quite frankly, it's one of the reasons why all four metrics exist, right? It gives you a total view, right?
Yeah.
So
yeah, because you can absolutely manipulate it with a refi. And I mean, and
yeah,
most deals, if you have a refi in year 1 or year 2, most deals will hit your 20% IRR.
pretty quickly.
Yeah, pretty easily, right? I mean, and anything above that is actually even better, right? So like when you're working with a private equity fund and they are IRR focused, right? It's because they want to deploy money and then get it back as fast as possible.
Yeah,
right. Turn and burn. As a syndicator, right, and somebody that raises money from private equity firms, usually your waterfalls are dictated upon your IRR metric. So you are incentivized to go into a deal and do your value add and refinance it as fast as possible, because once you reach that 15% IRR seems to be the magic number, the waterfall splits change, right? Because your incentive or your promote is more beneficial on the back end with a higher IRR. So how, as you a sponsor, how do you get a higher IRR and make more money? Is refi as fast as possible, right? I mean, that's why it's like pedal to the metal. We are bulldozing through this deal as fast as possible, because I know as a sponsor, the the pot at the end of the rainbow is much bigger for me the faster we can refinance that money and bump up that IRR as high as possible.
Yeah, that's one of the reasons why. It's one of the reasons a lot of folks that are flipping don't realize it, but they're exploding their IRR, right? Like
Yeah.
their deals are like IRR crazy, right? And then, um, that's one of the things that I do like. It's one of the reasons the Burr strategy works so well,
Hmm.
is that it's kind of the best of both worlds, right? As well as, it's got deal stacking where you're turning your money, you're creating equity, and at the same time, your cash flow is going up ideally because, right, you're deal stacking.
Yeah.
You make $10 a month, you go buy something else, you're buying $50 a month, you're still making that 50, you buy something else and you added another 50 to it. So now you're making 100, and it's a great strategy. And yeah, I've actually seen some folks try to incorporate that into like the multifamily world, right? Because typically Burr is something you think about in the single family space, but you see some guys doing it successfully in the multifamily world, and it's a really effective way to do deals, quite frankly. Um,
Yeah,
the
there's no wrong way to do deals, right?
No,
I mean,
no,
there's one of the guys in the other mastermind groups that I'm a part of, Mike Preshman. He's a diehard buy and hold forever guy, and him and I
yeah,
go back and forth all the time, and I take shots at him. Yeah, Dennis, velocity to capital for me. I want to increase my equity, and I want to realize that equity so I can redeploy it and re-leverage it
yeah,
up.
yeah,
Because my thing is like, okay, well, if you do a Burr, right, you're never scaling. You're scaling in number of properties, but not in size. Because if I have 100,000 and I can go increase I can go buy a property for 400 grand, I can increase it to 550, then refinance out my 100 grand. Well, now I have to go buy the same size deal all over again, and you don't get those economies of scale. I would much rather sell my property now that if it's worth 550, walk away with 250,000 and go leverage it up and go buy $1 million property, right? Because then my $1 million property, I can then hopefully I'll have $500,000 and I can go leverage it up and buy a $2 million property, right? You see how it continues to grow. Um, the whole benefit of doing multifamily with a lot of doors under a single roof is exactly that, right? One tax bill, one insurance bill, one property to pay focus to, and you can continue to grow and scale. And at a certain point in time, you're going to be getting different properties that you can put underneath your umbrella. And if you do the buy and hold, and you want to buy, a 5 unit, a 6 unit, an 8 unit, a this and that, and you want to have a bunch of different properties, that's fine too. It's just not how I like to operate.
yeah. You can, and I think there's one thing there that we should pivot and edit just a little bit. You can scale in that model, right? It's
Yeah,
just that,
it's
it's
different.
think of it like Monopoly, right? You buy four houses, you sell the four, you buy a hotel, right? So
Mhm.
it's a little bit of a different model. Whereas you buy a 20 unit apartment complex, and you do a value add, so the next time when you sell it, you're able to go buy a 30 unit the next time, right? That kind of thing. So similar concept. It's just a different way about going about it. Um, but I mean, either way, the idea in this space is to scale in some way, shape, or form. I mean, so that but like Tim's talking about, like it all depends on where you are. It all depends on where your investors are, and I love the question of like, what deal is going to work for my investor, and I'm like, I don't know. I,
Beats
go
me.
talk. Go. What's your investor tell you? What
Yeah.
are they looking for?
What do they want? What more importantly, what do they not want?
Right. Yeah.
Um,
Because
Albert,
you
I'm
know.
not talking about a 1031 here. I'm talking about realizing capital gains and moving it on to the next deal.
Yeah. Because by the way, guys, there's ways to roll money into other deals without a 1031
Yeah.
and not take the tax hit. So, um, but I always use the extreme example, right? Like, does can I buy with my investor group, with my investor base? Can I buy a deal in Los Angeles that makes sense for my investors? No.
Not at all.
That's all about appreciation, and equity multiple may even be cash flow negative for a little bit, that kind of
Mhm.
thing. My investors don't want that. most of my investors are looking like a blend. They're in between everything that we've talked about. I want an equity multiple in the twos over 5 to 6 years. I'm looking for a 10 to 12% cash on cash with an IRR of 18. That's the kind of thing my investors are looking for. So LA doesn't work for them, guys.
Yeah, I mean, because I bet your IRR in an LA deal is going to be very low. I mean, the equity multiple could be very high, but the IRR could be very low because if it's cash flow
Possibly.
negative, and you don't
Yeah.
receive any payments for 5 years or 10 years, and then in year 12 you get a huge windfall because it's gone up in value.
Right.
It's just different, right? Every investor is going to be different. Every investor is going to want something different. And I mean, I have been genuinely shocked about putting an offering in front of somebody and me saying, oh, I know they're going to take the equity, and then they don't. They take the cash flow position instead. Like, it was like, oh, I would have never thought that that person would have done that, but their needs have changed and their desires have changed and their risk profile has changed and everything changes all the time, right? So that's why you have to continually talk to your investors about the metrics that they're interested in, talk to them about their personal lives, talking about what they're doing with the money, where's it got to go, what do they plan on doing with it. There's a lot of conversation that can be had so that you can have the best understanding of what is going to be a successful offering to put in front of that investor and increase your close ratio.
Yeah. So a lot of the guys that come to us, I talk to them about like a 2 or 3 step approach, which is, they'll come to us and they'll go, I don't have a ton of money to start this thing. What do I do? Okay. So we're talking OPM, you need to go raise money from investors. You operate it. You build your equity through sweat equity, right? So you're not making a lot of cash. You're kind of relying on some fees up front, right, to get you through those first 2 years. The end of the 2 years, you've made some money. You're able to put it back into deals and start to create some cash flow. So it's like you're very focused on equity multiple for a little while in order to build that kind of, that bankroll, if you will, that you then put into something that's creating some cash flow with you. And the beautiful thing about that is, it's like a grind for 2 or 3 years, right, where you're building that bankroll. But then you go put that bankroll into something, and now you've got a little relief because you got cash flow going on. And now it's not quite the grind it used to be because you're able to say, you know what, I don't have to struggle for the next deal. I can be a little more patient for the next deal, right? Because my bills are paid. That cash flow is paying my bills. And by the way, I got my bankroll sitting there earning me money, and I have this equity build up. And then you do it again, you do it again, you do it again. And, that's how you look at folks like 10, 15 years down the road. And they've like, man, I started with $1,000 in my pocket. And now I got $15 million, and they're making two, three, $400,000 a year in cash flow, the easy way. So,
Yeah.
there's a million ways to go about this, guys. A million.
Oh, I know it. I mean, that's the fun part about it, right? It's kind of a problem. It's a giant jigsaw puzzle. What investor metrics are this person chasing, right?
Yeah.
Is it cash flow? Is it equity? Is it depreciation? Oh, that's a hot button. We didn't even talk about depreciation because it's not really in return metric, but this is something that a lot of high net worth individuals, they are chasing depreciation. Again, another person we work with, they are interested in depreciation. So, Tim and I have an abundance of depreciation. So we're like, hey, we're going to give you 100% of the depreciation. Because I know this is going to benefit you more than it's going to benefit us. So here you go. Right. And that made it a lot easier for them to say yes to do this deal because not only did they have, a great return metric first and foremost, but secondly, they actually had an ancillary benefit that they wanted that and we didn't really need. So it's kind of like a hair, one hand wash the other scenario.
Yeah. So, Dennis, good question. I'll say this: it depends. It depends. I mean, just because they're LIHTC doesn't make them one way or the other. They're just like any other deal. It depends. It depends on your purchase price, depends on how high the rents can go, depends on location, depends on what your value add strategy is. It just depends. We have some that have like crazy equity multiples and high IRRs, and we have some that the equity multiples a little bit lower. It's cash flowing really well, and then we have some that are a blend of both.
Mm-hmm.
So it really, it's just like any other deal. Depends.
Yeah, it is like any other deal. There's really no difference between the LIHTC deals that we do, the low income housing deals that we do. The numbers just look different. Like your purchase price, your property taxes, your debt, your income limits, like all of that looks different, but the principles of doing a real estate deal don't change. So, it's a different way about going about it, but like at the same time, it's the same. It's the same but different.
Yeah. Yeah. I mean, at the end of the day, the real difference is in the business plan.
Yeah.
That's where the biggest difference lies, is how you operate it. And then what you got to do to make sure that you're operating it within boundaries and compliance.
Hmm.
Um, that's the biggest difference.
Yep.
So anyway, man. So, hey, Tim, what are you focused on right now? Where are you looking? You asked me. What are you looking at?
Oh, that's not fair. You're not supposed to ask I ask
Come
the
on, man.
questions around here. uh man, for me right now, it's definitely I'm paying a lot more attention to a blended return instead of full on equity growth because I need more cash flow. So I am paying more attention to absolute dollar amount that the money is going to pay out from the start. Because essentially what I'm doing now when I'm selling some assets that are cash flowing, that are paying me distributions, I'm looking at, okay, well, this deal pays me 80 grand a year and I'm going to cash out all this equity. And I need to make sure that my cash flow stays the same on a year to year basis. Because my idea there on with the velocity of capital is I want to make sure that my balance sheet is going to continue to grow. My equity multiple is going to continue to grow. But my cash flow, I want it to stay the same and continually rise. Because if I can trade from one deal to the next with no change in cash flow, then it's no harm, no foul, right?
Right.
Like I like to think of it as my wife won't feel the difference. If we move the money to a different deal, she's not going to feel the difference because the cash flow stays the same. But I'm going to notice the difference because I pay attention to our balance sheet and continually growing. And the reason I sell a deal is because I've gotten as much growth, equity growth out of that deal as I can. So for example, if I have $500,000 in equity, right? Will the deal that I own go to $1 million in equity? Probably not.
Right.
What are the chances that I can take this $1 million, invest it into a different deal, and get it to $1 million? Much higher, right? So I'm paying attention to that side of things. I'm trying to trade out money to keep my cash flow the same or very, very, very similar, but with future projections of being able to continue to grow.
Yeah.
Is that fair?
Yeah. Yeah. That's a great way to say it. And hey, what's up, Aquino? Good to see you, buddy. And I don't disagree with you at all there. Because you and I have talked about this sometimes too, right? Like I have a 16-year-old daughter, and I kind of say to folks, folks ask me sometimes, they're like, why don't you just go do this? And I'm like, because that has an impact on my family. And if it was just me, I'd be willing to live in a car and sleep down by the river and shower at the Y. But I don't want my daughter to do that. I've gotten her used to a certain lifestyle. So I don't want to
Mhm.
just do this. So like Tim's talking about, I want to make sure things I do, my family maybe doesn't notice, the difference, right?
A change or any much change at all. Yeah. Keep it
Yeah.
like for like change.
Yeah. I mean, if they notice a change, it's that we flew first class instead of coach this time, right?
Yeah,
Like
right, right. Yeah,
that's the change I want them to notice.
right. Yeah, no, I think that that's valuable because it scratches my itch to make sure that I'm continuing to grow, but it makes
Right.
sure that my family feels secure and they don't really notice the difference. But it's a double-edged sword because, you have that conversation of, well, you're doing all of these things, but I don't feel any different. I'm like,
Yeah.
exactly. That's the
Yeah.
beauty of it.
Yeah. And guys, sometimes that's a sign that you're doing it right in that window, right?
Right.
Like,
Yeah.
because you do have that window. Like I'm gonna say, Tim, I'm gonna say something, and probably somebody's gonna blast me for this, right? But I'm gonna say it anyway. Because you'll see guys sometimes and they're not doing anything, and the next thing you know, they're driving a $200,000 car, right?
Mhm.
And it's like you went from zero to Lamborghini real fast. And it's like, congrats, or did you take everything you made and buy a $200,000 car, right? And it's like
Mhm.
there's that window where you should be growing probably and nobody notices,
Yeah.
right?
Right.
Yeah. Yeah. And that's kind of what we talk about when people are like, "Man, you guys had all the success so fast." It's like, "No, no, you're
Mm-mm.
just seeing it now."
Yeah,
Right?
right. You're
You're just
seeing
seeing it
it
now.
now. Yeah, yeah, that's funny.
Like one of the best thing, you know, you guys know that I know Mike Ely and stuff like that. Mike went through that phase for a little while, like nothing, nothing, nothing. And then he calls me one day. He's like, "This is the year I'm going to buy some toys."
Oh, I
And it
remember
was like,
that phone call.
yeah, yeah. And it's like nothing, nothing, nothing. It's like, oh, Mike's got a Bentley. Like,
Yeah. Oh, yeah, yeah, I remember him shopping for that one.
but man, what you guys didn't see was like the years and years and years of Mike living in the same house, driving the same car, or whatever. Most people didn't see that.
Yep.
You know,
Yeah.
so
Hey, real quick before we wrap it up, Isaac asked a good question. He said, "For your current investor base, do they lean more towards cash flow or higher equity multiple?" Again, it's a blend, right? So it's that's why we do a lot of our offerings with two classes of shares. Class A shares are more of a kind of a debt position where it's interest only. You're getting, you're in the first position behind the bank. You get your 12% preferred return, typically paid monthly or quarterly. You get your money first before anybody else. Your entire pref is paid out before anybody else gets anything. Your investor money is returned first before anybody else's. So it's a very secure position, but you don't have any of the equity upside.
yeah,
So we
yeah,
offer options for our investors because sometimes what we find is they want a little bit of both. So then they might put, instead of doing $100,000 in one or the other, they'll do $100,000 in an A share, or they'll do $50,000 in an A share and $50,000 in a B share. And our B shares typically have, they share in the equity. They have a 7% preferred return, or maybe even an 8% preferred return. And like your blended preferred return on those deals is like, if you do 50-50, call it 10, you got a blended 10 pref, which is great. You also get a little bit of equity. You get a little bit of depreciation to help offset the cash flow. So it really is kind of a win-win scenario for our investors when they kind of split it between both. But some investors are, I only want A shares, and some investors are, I only want B shares because I want equity growth and I want preferred return. And I'm fine with taking a little bit of risk to go for the ride.
yeah. And not to get too far over here, guys, but Isaac, one of the beautiful things about that is like Tim's talking about, we have some looking for the cash flow, and then we have some looking for that some cash flow and some equity, that blend, right?
Mhm.
So the beautiful thing is on deals where it will work, Tim will call me up and literally he's like, "I'm going through the underwriting, man. You want to get paid now or you want to get paid later?" Right?
Yep.
And that's an opportunity for Tim and I to say, my cash flow position is pretty good right now. I'm really looking for some equity. So
Mhm.
give these guys all the cash flow. Let's keep a little more equity, right?
Right.
And
Right.
it's a beautiful option to have, quite honestly,
Yeah.
guys.
I wouldn't say we put ourselves in any bucket. We
No,
look at each deal individually. We look at our situations individually. We look at what our investor base is asking. I mean, because I get text messages all the time like, "Hey, when's the next deal coming up? What do you
yeah,
got coming in? What's in the pipeline?" Because a lot of investors are like Tim and I, and they're like, "Well, I'm kind of, I'm expecting a couple sales coming up in the next 30 or 45 days. What do you have under contract so I know where I can move my money to?" And they're kind of doing some research that way now.
yeah,
So it's fun. It's a game. I love this game. It's the best thing. It scratches a big itch for me. I wholeheartedly enjoy it. I love helping my investors too because we sit down, we talk about these things about what are you looking for, what do you need, what do you not need. And it's a continual growth. It's a continual journey. Your needs, your investors' needs, everybody's needs are going to change along the way depending on the situation. So
yeah,
cool.
yeah. Well,
All right,
cool, guys.
guys. Well, thanks for joining today. Appreciate it. This was a fun one, and we'll see you again next time. Peace.
See ya. Have a good week.